Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, our stock market was up today, and there was one main reason, a spike in the iron ore price. So what is the outlook, and can this rise be sustained? Commodity Watcher Morgan's chief economist Michael Knox will tell us what we need to know. Right now, there's been a rush for new listed investment companies, or LICs, on the ASX, and it comes when ETFs are also all the rage. So what is the best option, LICs or ETFs? I've got Paul Rickard doing the numbers on these alternative investment products. We'll test the real estate market with Mark Daniels of Smartline. Is it getting more bubbly? And are parents helping their kids a part of this bubbly story? And we will check the pulse of the art industry at a time when new buyers are starting to show interest in art as an investment. And we'll see if the federal government regulations on super are helping or hurting the industry with Tim Olsen. Stay with us for the next hour and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to Switzer at switzer.com.au. You can follow me on Twitter and the handle is @PeterSwitzer. A reader to my daily blog on switzer.com.au, Dino, thinks I'm obsessed about interest rate cuts. And I have to say, Dino, my colleague Paul Rickard did ask me on Thursday, have you written on interest rates again? But let me inform you, Dino, I am not obsessed about interest rates. I'm telling you, I'm not. However, I am obsessed by the economy and its impact on the stock market and the knock-on effects it has onto the stock market, the value of our portfolios and our super. I'm obsessed with helping people make money, build wealth, build businesses, employ Australians, and all the good things that comes from a positive, confident band of consumers and business investors. I can't say I can feel the same intense passion or obsession when I listen to our RBA Governor Glenn Stevens. Getting the economy back to normalcy seems to be just another process job for Glenn. And Joe, despite the fact I would call him a friend, I can't kid myself that he has shot the lights out as Treasurer. His first budget was more politically driven, trying to get into deficit and debt reduction ASAP. It was good politics as you get the hard stuff out of the way early, and then you hope we can forgive you in the ensuing 2 years. But it was bad economics. The economy was already faltering when they tried and failed in the budget, so it kept the pressure on interest rates and poor old Glenn, and that's why I talk about rates all the time. Confidence has been low and we really only have had interest rate policy trying to boost demand and also bring the dollar down. But even this was done in a careful, public servant, actuary kind of way by Glenn. I reckon this slow cut process, drip by drip, 0.25% by 0.25%, is like the opposite of what happened when Bernie Fraser and Paul Keating raised rates too slowly in the late 1980s. Home loan rates got to 17% before we capitulated into recession. I think if Glenn and the RBA had cut deeper, quicker, earlier, the dollar would have dived earlier, the stock market would have risen earlier, and we'd be further into an economic recovery. And we'd be closer to the first rate rise, which means we'd be closer to a more normal Aussie economy. Dino, I am obsessed, but it's not about interest rates. I'm obsessed about getting this economy right again, and I am obsessed with helping my viewers, readers and listeners make money. And if the government officials get in the way or underperform, well, they're going to hear it from me. That's my job. Iron ore prices have spiked again over the weekend and have helped our market once again, threatened the 6,000 level on the S&P ASX 200 index. So what is the outlook for iron ore prices? Have they turned the corner? And how important are they for our stock market? Michael Knox is the chief economist for Morgans and is a 24/7 watcher of exciting things like iron ore and oil prices. Michael Knox, welcome.
Good evening, Peter. I've been fascinated to listen to your obsessions, I must say.
All right, Michael, I won't ask you if I'm right, because you always give me sort of a 50% pass mark. You never give me a high distinction. But do you think, just before we start on the iron ore price, was a great story. Do you think that maybe we should have got these rate cuts over quicker, get the thing happening?
I think you should be obsessed by unemployment because when I run the numbers, if you're concerned basically about inflation then you can leave interest rates where you are. And that's the way the consensus is running, that there'll be, you know, maybe one more rate cut, but unemployment is going to stay at 6.2% as far as the eye can see. But if you're obsessed about unemployment, then you've got to have further rate cuts. And so I think, as I've said before, we need a short rate with a one handle in front of it, and that's entirely and precisely what's that driven by is the need to get unemployment down to the low 5 level, which is what labour market economists call the natural rate of unemployment, where you have to get unemployment down to the low 5 level to stabilise inflation.
So that comment of mine got an HD from you, Knoxy, but I won't ask you whether it's an HD or not. We'll just leave it at that. Let's look at the outlook for iron ore. And someone asked me today, you know, what's happened, and I said, well, one trigger was that BHP basically said, well, we're going to be slower getting to our target, and the market took off. But what were the real reasons that iron ore is starting to take off? And do you think it can keep on taking off?
I think there's been a number of markets, of commodity markets, which have been heavily oversold, and they've been heavily oversold because the US dollar has been very strong. But what we've seen in recent days is we've seen the US dollar index appear to reach a top at around about 100 and come off from there. And since that, we've seen a number of commodities rally. We've seen the oil price rally, we've seen the copper price rally, and we've seen the iron ore price rally. Sadly, I have to tell you that of all of those commodities, iron ore is the least likely to sustain a major bull market. Looking at the numbers today, Chinese steel production is around about where it was this time last year. It's pretty much dead flat, and that didn't matter because for a couple of months at the end of last year, iron ore stocks at port in China were actually falling. But now, this year, since January, they've gone up about 6%. So that means if consumption is flat and stocks are rising, then the stocks to consumption ratio is going up, and that puts downward pressure on prices. So we think that the iron ore price, based on where stocks are now, is around about $65 a tonne. Which is only about $8 higher than it is. So there's still so much supply, so much physical supply in iron ore that you've got a lot more upside in, say, copper or aluminium or even oil than you have in iron ore. But it was so oversold, like a number of others, that with just a little bit of weakening in the US dollar, it's one of the commodities that's gone up.
All right, now, a couple of things, Mike. Do you think iron ore prices will fall back to where they were, or you suspect they're going to hang around these kinds of levels?
I think as long as the US dollar stabilises and doesn't rally again, I think it can stabilise. A number of commodities can stabilise around these levels, including oil, including aluminium.
All right, now, the brilliance of having someone with a mind as big as yours when it comes to economics and numbers is that you can explain something a lot of my viewers probably don't get. I want you to do it as simply as you can so people can understand what's going on, that great brain of yours. You made the comment that US dollar strong, commodity prices down. Explain simply why that happens.
Well, yeah. Well, there's the long story and the short story. I guess
short,
the
easy one, please.
Yeah, that the US dollar has risen very dramatically since September last year. The increase has been one of the fastest since the 1970s, and as international commodities are priced in US dollars, as the US dollar goes up, then everything in US dollars go down. Now, what also happens, though, is a lot of people financing inventories in transit, like oil on ships or iron ore on ships, they try and deliver more rapidly to try and reduce their transit risk and their financing risk, and that generates the appearance of a short-term oversupply that drives the market down further and exaggerates the sell-off in US dollar terms. So when the US dollar stabilises, you don't just get the currency stabilisation effect, you get delivery times coming back to normal levels, a little bit of a drop-off in short-term supply, and you get a little bit of a pop in prices. You've seen that most significantly, I think, in the oil market, but you're now also seeing it in a number of metals, and we are seeing it just this week in iron ore.
Okay, let's go to oil. Why are you more positive on oil and, say, copper?
We didn't believe from the start that what we were seeing was a glut, that is to say oversupply. The numbers that OPEC have continued to provide suggested that if there was excess supply, it was only around about 2 million barrels a day, or about 2% basically. And that wasn't enough to drive down the price by 50%. But what we thought was happening was an inventory panic, just like a financial panic, but just in a commodity, and that was a panic in those people who were financing inventory in transit of oil, and therefore they were delivering it more rapidly, and therefore there was a short-term oversupply, and therefore the price was going down. So that's an inventory panic. Now, what, of course, is happening this year is we've seen the number of oil rigs in the US drop by 45%, since the middle of last year. And that's been a noticeable, or we believe, when GDP comes out at the end of this month, which is only a few days away, that what we'll see is very sharp decline in the petroleum sector in the first quarter. Estimated to be as much as 60% decline in activity. So what that means is the level of US produced oil, the production will be falling. By the time we get to the second half of the year, that appearance of oversupply will be disappearing, and then that supports a recovery in the oil price. And we've thought it will only take a couple of years for the oil price to get back to pretty healthy levels.
What's that?
And that's, $80, $90 a barrel. But that's only possible because what we've had is an inventory panic, not a genuine glut.
Okay. Do we need, you mentioned earlier a rate cut to help unemployment. Do we still need a rate cut to improve your fair value calculations?
Well, our fair value calculations are driven by earnings per share and bond yield is the long end of the yield curve, not the short end of the yield curve.
Yes.
I do think that the rate cut in the early part of the year was a trigger for the rally in the stock market, but then the stock market was, 600 points cheaper than it is now.
Yeah.
So it was genuinely very undervalued back then, and the rate cut then was a trigger that helped it rally up towards fair value. But now I think fair value right now is about 56.50. So I think we're a couple hundred points overvalued right here. So I don't think a rate cut is going to generate any kind of sustained rally in stock markets. I mean, I think a rate cut is important. More than one rate cut is important to generate investment, to generate employment growth, to bring unemployment down from 6.2% to something in the low fives. So I am certain that given enough time, the RBA will come to exactly that view.
And one last one, Greece. Is Greece going to be a problem for global stock markets?
That's more than the last one. I think that there's definitely a break point here between what the Greek political process has achieved in terms of who it's elected and what the Eurogroup is prepared to tolerate. So I think that this disagreement with Greece is going to go to the wire, and then it's going to go beyond the wire. And I think that's going to be very scary for markets when it happens, because the assumption has always been that this will be solved pretty quickly by negotiation. And I don't think that's going to happen, Peter. I think this is going to be a tougher slog than anyone imagines.
All right, mate. Thanks for that. Talk to you in a couple of weeks' time.
Thank you, Peter.
After break, we'll road test ETFs versus LICs with our Top Gear guy, Paul Rickard.